Hello, listeners. Welcome to the Credit Compass, the podcast that helps you navigate the world of European credit. I'm Gordon Kerr, European macro strategist and host. Welcome to today's episode, where we delve into recent pivotal developments shaping the economic landscape of the United Kingdom and Europe. We'll explore the Bank of England's latest monetary policy report and its implications for the UK economy. We will analyze the dynamics of Germany's upcoming federal election and its potential impact on European credit markets, and conclude with insights from the recent Purchasing Managers' Index data, shedding light on European economic activity at the start of the year. Let's dig in. On the 6th of February, the Bank of England released its quarterly monetary policy report, providing a comprehensive analysis of the UK's economic conditions and the rationale behind its recent monetary policy decisions. In a move aimed at stimulating economic activity, the bank reduced the base interest rate by 25 basis points to 4.5%, marking the third cut in 6 months. This decision reflects concerns over a stagnating economy and the persistence of inflationary pressures. Within the report, there were several important notable highlights worth mentioning. Number one, economic growth. The bank has halved its growth forecast for 2025, now anticipating a modest expansion of 0.75%, down from the previous estimate of 1.5%. This revision underscores the challenges facing the UK economy, including subdued consumer spending and business investment. Number two is around inflation projections. Inflation is projected to rise to 3.7% by mid-2025, driven by factors such as increased wholesale gas prices and higher regulated fares. This uptick in inflation poses a dilemma for policymakers, balancing the goals of stimulating growth, much needed growth, and containing price pressures. However, they are confident that the rise is temporary and inflation will fall back to 2% after this temporary increase. Lastly, with regards to the labor market, unemployment is now expected to increase to 4.75%, reflecting potential slack in the labor market as businesses navigate economic uncertainties. In my view, what is most notable in this report is that these developments have led to a shift in perspectives among some monetary policy committee members. Catherine Mann in particular has long been a voice against consensus for cuts under the premise that wage growth remains too high and thereby likely to keep inflation elevated. In this latest meeting, the consensus favored a 25 basis point cut with a 7-2 vote. The minority advocated for a more aggressive reduction of 50 basis points, including Catherine Mann herself, citing concerns over the fragility of the economic recovery. Her commentary on Tuesday, the 11th of February, in a speech, also highlighted that because she had voted for 50 this time, did not mean that she was dovish and remained of the view that the UK warranted restrictive activity in the future. Her vote was more of an active approach to policy rates, in her words. Could we be facing a stagflationary environment in the UK in the first half? According to a Bloomberg survey in January, expectations were for only 1.3% GDP growth in 2025 and a 35% chance of recession in 2025. Perhaps the muted reaction from the credit markets highlights that while growth expectations may be muted and falling, credit should still perform. Turning our attention to the continent, and more specifically Germany, there is a federal election scheduled for the 23rd of February. This presents a critical juncture for the nation's economic direction and, by extension, the broader European economy. This election features a contest primarily between the incumbent Social Democratic Party, or SPD, led by Chancellor Olaf Scholz, and the opposition Christian Democratic Union, the CDU, headed by Friedrich Merz. Germany's economic challenges are at the forefront of the electoral debate. The country's industrial sector, particularly manufacturing, has struggled to regain momentum, with production levels remaining below pre-pandemic benchmarks. This stagnation raises concerns about Germany's traditional economic engine. The SPD Green Coalition advocates for increased public investment and a relaxation of fiscal constraints to stimulate growth and facilitate a green transition. In contrast, the CDU emphasizes fiscal prudence, proposing tax reductions, spending cuts, and adherence to the debt brake to maintain fiscal discipline. Recent polling indicates a competitive race, with shifting voter sentiments influenced by economic concerns and policy proposals, as well as a rise in the views from the far end of the left and the right, especially the right-leaning views around the global hot topic of immigration. The election's outcome will have implications for European credit markets, as Germany's fiscal policies play a pivotal role in shaping investor confidence and regional economic stability. Many still hold that the base case scenario is for no major surprises, but the rise of the far-right AfD party has many concerned given the recent support from Elon Musk. There will be a lot of attention paid to this election given the implications for European growth, and opening of fiscal constraints could have implications given the country's relative spending power. Merz appears to be in favor of a change in the failing German industrial model. Fixing the economy and controlling immigration are the top priorities, both to help the country as well as to stave off a rise in populism. His challenge will be the concessions that will need to be made to form a coalition. Speaking of growth, perhaps one of the reasons for the ongoing positive market momentum in Europe is while growth is slow, the prospects for it rising are increasing. Recent data from the Purchasing Managers Index offers a nuanced view of economic activity across the eurozone. In January 2025, the HCOB's composite PMI for the eurozone bloc rose to 50.2 from December's 49.6, signaling a modest return to growth after 2 months of contraction. Germany was a part of this improvement, increasing its composite PMI for the month. The UK composite PMI fell marginally to a reading of 50.6, but it remained above the important inflection point of 50. 50 is viewed as expansionary when the PMI is above it, and contractionary when the PMI is below 50. Looking in further detail, the Eurozone Services PMI increased to 51.3, indicating expansion and highlighting the sector's resilience amid broader economic challenges. Again, the UK results were below consensus and down from the prior month, but still above 50 at 50.8. Despite ongoing difficulties, the Eurozone manufacturing PMI improved to 46.6, suggesting signs of stabilization, though it remains in contraction territory, with Germany actually contributing to the improvement. Similarly, the UK manufacturing PMI rose marginally, but remains contractionary at 48.3. While these indicators point to a tentative recovery for the Eurozone, challenges remain, particularly for the UK, as it shows signs of a turn. Political uncertainties, including the forthcoming German election and potential policy shifts, contribute to a cautious outlook among businesses and investors. Additionally, rising input costs and price pressures may pose headwinds to sustained growth. We continue to hold the view that there will be a large degree of differentiation amongst countries as we progress through 2025. The UK's about-face in the past several months, as well as the potential impacts of threatened tariffs, highlights the volatility that is likely in the year ahead. In summary, the economic landscape the UK and Europe is navigating a complex interplay of policy decisions, electoral outcomes, and market indicators. The Bank of England's recent commentary reflects a delicate balancing act between fostering growth and controlling inflation. Germany's impending election presents divergent economic philosophies with far-reaching implications. Meanwhile, PMI data offers a glimmer of optimism, for some, tempered by prevailing uncertainties. Thank you for joining us in this analysis. Stay tuned for further updates as we continue to monitor these developments. As always, staying informed is key to navigating these complexities. Thank you for joining us on the Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future episodes, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.